Here is something that will sound wrong the first time you hear it. When a company pays you a dividend, when that cash lands in your brokerage account, you are not richer than you were before it arrived. Not richer, the same. Exactly the same net worth, to the cent. Here is why. On the day a stock goes ex-dividend, the date on which buyers of the stock no longer qualify for the upcoming dividend, the stock price falls by approximately the amount of the dividend per share. If a stock is trading at $50 and pays a $1 dividend, the stock opens the ex-dividend date at approximately $49. You receive $1 in cash. Your share is worth $1 less. Your total position, cash plus share value, is identical to what it was the day before. This is called the Dividend Irrelevance Theorem, and it is one of the foundational concepts in academic finance, and one of the least known ideas among retail investors who are building dividend portfolios. Now, does this mean dividend investing is pointless? Absolutely not. There are genuine, powerful reasons to own dividend-paying stocks that this video covers in full. But understanding what dividends actually are, and what they are not, is the foundation for using them correctly. This video covers the 7 most common misconceptions about dividend investing. Some will be familiar. Some will surprise you. All of them, if believed uncritically, are either costing you money or leading you toward the wrong portfolio decisions. Starting now. The misconception: getting paid a dividend is getting paid. Cash arrives in your account. You are wealthier. Where it comes from, it feels intuitively true. Cash arrived. Cash is wealth. Therefore, wealth increased. This is the most natural reading of the situation, and it is why the misconception is so persistent. Why it is wrong. As described in the hook, on the ex-dividend date, the stock price is reduced by approximately the dividend amount. The company has transferred cash from its balance sheet to shareholders. That cash was already part of the company's value, and therefore part of the share price. When it leaves the company, the share price adjusts downward by the same amount. Your total economic position, shares plus cash, is identical before and after the dividend. The technical term, this is the Dividend Irrelevance Theorem, developed by economists Modigliani and Miller in 1961. Their core argument: in an efficient market with no taxes or transaction costs, a company's dividend policy does not affect the total return to shareholders. A company that pays a $1 dividend and has its share price fall $1 produces the same outcome as a company that retains the $1 and the share price stays at its pre-dividend level. Why dividends are still valuable? The real reasons. The Dividend Irrelevance Theorem is not an argument against dividends. It is a clarification of what they do and do not do. Dividends are valuable for specific, real reasons. They force capital discipline on management. Companies that pay regular dividends commit to returning capital to shareholders, which limits their ability to waste money on poor acquisitions or empire building. The dividend is a commitment mechanism. They provide a return during flat price periods. If a stock price goes nowhere for 2 years but pays a 4% annual dividend, shareholders still earned 4% per year. The dividend is the return when price appreciation is absent. They enable tax-efficient income in retirement. In Canada, eligible dividends receive preferential tax treatment, and inside a TFSA, they are tax-free entirely. The structure of dividend income has genuine tax advantages over other income types in specific contexts. Reinvested dividends compound powerfully over time. As covered in the DRIP video, reinvesting each dividend into additional shares creates a compounding loop that builds wealth dramatically over long time horizons. The corrected understanding, A dividend does not make you richer on the day it arrives. What makes dividend investors richer over time is the consistent reinvestment of dividends into additional shares of quality businesses that themselves grow their dividends, creating compounding on compounding. The arrival of the dividend is not the value creation. The reinvestment is. The misconception: a 9% yielding stock is better than a 4% yielding stock because you get more than twice the income. Where it comes from, yield is a simple, visible number. Higher seems better. This is the same thinking that makes people choose the savings account with the highest rate without checking the conditions. Why it is wrong? The yield trap. Dividend yield is calculated as annual dividend divided by share price. A high yield can mean one of two things, and only one of them is good. Good high yield. The company is genuinely profitable, distributes a large share of earnings as dividends, and the business model supports sustained high payments. These are rare. Dangerous high yield. The share price has fallen significantly, pushing the yield calculation upward artificially, because the market has priced in concerns about the dividend's sustainability. A stock that was paying $2 per year in dividends at a $40 share price, 5% yield, may now be trading at $22, 9% yield, because investors are worried the dividend will be cut. If the dividend is cut to $1 per year and the share price falls to $15, the investor who chased the 9% yield now has a stock worth $15 that pays 6.7% on a much smaller capital base. They lost 32% of their capital to capture a high yield that did not survive. The payout ratio is the test, not the yield. The payout ratio, dividends paid divided by earnings per share, tells you how much of a company's earnings are being paid out as dividends. Below 60%, room to grow, sustainable. 60 to 80%, watch it. Above 90%, the dividend is at risk unless earnings grow significantly. A 9% yielding stock with a 110% payout ratio is paying out more than it earns. Unsustainable by definition, and a dividend cut is likely. The corrected understanding: yield is an output, sustainability is the input. A 4% yield from a company with a 45% payout ratio, 30 years of consecutive dividend increases, and 8% annual earnings growth is dramatically more valuable and safer than a 9% yield from a company with a 95% payout ratio and declining earnings. High yield is a starting point for investigation, not a quality signal in itself. The misconception: dividend-paying stocks are conservative, safe investments, appropriate for risk-averse investors who do not want to lose money. Where it comes from, dividend stocks are often described as income stocks and contrasted with growth stocks in a way that implies the former are stable and the latter are risky. The quarterly dividend payment gives the impression of a bond-like predictable income stream. Why it is wrong? Dividend-paying stocks are still equities. They are subject to the same market volatility as any other stock. In the 2008 to 2009 financial crisis, major Canadian bank stocks, among the most reliable dividend payers in Canadian history, fell 40% to 60% in price. Royal Bank fell from approximately $60 in 2007 to approximately $28 in early 2009. It continued paying its dividend throughout, but an investor who bought at $60 and watched the price fall to $28 was experiencing very real, very substantial paper losses. The dividends did not prevent this. The specific risks unique to dividend stocks. Interest rate risk. When interest rates rise significantly, dividend stocks face downward valuation pressure as GICs and bonds offer more competitive yields with lower risk. This is exactly what happened to utility and pipeline stocks during the 2022 to 2023 rate hiking cycle. Many fell 15% to 25%, even while maintaining or growing their dividends. Dividend cuts. No dividend is guaranteed. Bell Canada, BCE, once considered one of Canada's most reliable dividend payers, suspended its dividend in 2024 amid financial pressure from its restructuring. Investors who believed the dividend was permanent and held BCE based on that belief experienced significant losses. Sector concentration risk. Many dividend portfolios end up heavily concentrated in a small number of Canadian sectors: banks, pipelines, utilities, and telecoms. This is not genuine diversification. A portfolio of 5 Canadian bank stocks plus 3 pipeline companies is a highly correlated portfolio that will move together in adverse conditions. The corrected understanding. Dividend stocks are equities with the income characteristics of dividends, not substitutes for fixed income. They belong in a portfolio alongside bonds or other lower volatility assets for investors who need genuine capital protection, not as a replacement for it. The dividend is a feature of the stock, not a safety net. The misconception: when a dividend arrives, I should take it as cash. It is my money and I have earned it. Where it comes from, the feeling of receiving cash is psychologically satisfying. And if you are in retirement and need the income, this is absolutely correct. Why it is wrong during accumulation. During the wealth-building phase of investing, before you need the income, taking dividends as cash is one of the most expensive quiet decisions an investor makes. Each dividend taken as cash is a missed compounding cycle. The dividend is not reinvested. Those shares are not purchased. Those shares do not generate their own dividends. The compounding loop is broken every quarter. As illustrated in the drip video, a $10,000 portfolio over 30 years with dividends reinvested versus taken as cash produces approximately a $26,789 difference in ending wealth. From the same starting investment, the same stocks, the same period. The specific exception: if you are in retirement and need monthly income to fund living expenses, take the dividends as cash. That is the entire point of building a dividend portfolio. The income is what you built toward. Use it. If you are not yet in retirement and do not need the income today, drip. Every quarter. Without exception. The corrected understanding. The right dividend strategy changes by life stage. Accumulation phase. Reinvest everything. Distribution phase. Take the income. Many investors take dividends as cash during accumulation because it feels good, and in doing so, sacrifice tens of thousands of dollars in foregone compounding over decades. The misconception: you are either a dividend investor or a growth investor. These are separate, competing strategies. Dividend investors sacrifice growth for income. Where it comes from, financial media often contrasts income stocks, utilities, banks, telecoms with high yields, with growth stocks, tech companies with no dividends. This framing makes the two seem mutually exclusive. Why it is incomplete. The best dividend investments are not the highest-yielding static payers. They are companies that both pay and grow their dividends. Couche-Tard, ATD, has grown its dividend at 20% plus per year for approximately 15 years, while also appreciating dramatically in share price. Canadian National Railway has grown its dividend at approximately 15% per year over the past 2 decades, while tripling in share price. These are not income stocks that sacrifice growth. They are growth stocks that also pay growing dividends. The total return reality. A stock that pays a 2% yield and grows its dividend 15% annually, while also appreciating 10% per year in share price, produces a total return of approximately 12% per year with compounding dividends on top. This is meaningfully superior to a stock that pays a 6% yield with zero dividend growth and flat price appreciation, which produces exactly 6% total return. The corrected understanding: dividend growth investing, specifically seeking companies that grow their dividends consistently at rates above inflation, is not the opposite of growth investing. It is growth investing with an income component. The false dichotomy causes investors to either avoid good growth companies because they pay a small dividend, or load up on high-yield stocks that sacrifice all growth. The better frame: total return, with dividends as one component of it. The misconception: a dividend is a dividend. It does not matter whether I hold dividend stocks in a TFSA, RRSP, or non-registered account. Where it comes from, for many newer investors, the account structure feels like administrative detail rather than a meaningful financial decision. Why this is the most expensive misconception on this list. Canadian eligible dividends in a TFSA, tax-free. Zero tax at any point. On receipt, on reinvestment, on eventual withdrawal. The full 4% yield stays with you entirely. Canadian eligible dividends in a non-registered account, subject to the eligible dividend gross-up and tax credit mechanism. At $80,000 income in Ontario, the effective tax rate on eligible dividends is approximately 8.9%. At $100,000 income, approximately 25 to 30%. The tax is real and ongoing every year. Canadian eligible dividends in an RRSP. The RRSP provides tax-deferred growth. You claim a deduction on contributions and pay tax on withdrawals. But here is the specific problem. The eligible dividend tax credit does not apply inside an RRSP. When you withdraw from an RRSP in retirement, the eligible dividends that grew tax-deferred inside are taxed as ordinary income, losing the preferential eligible dividend tax treatment entirely. For Canadian eligible dividends specifically, the RRSP is less tax-efficient than the TFSA. U.S. dividend-paying ETFs in an RRSP versus TFSA, U.S.-listed dividend ETFs, VYM, VIG, etc., face a 15% U.S. withholding tax on dividends paid to Canadian investors inside a TFSA. Inside an RRSP, the Canada-U.S. tax treaty exempts these dividends from the 15% withholding, making the RRSP the preferred account for U.S. dividend-paying securities specifically. The optimal account structure for Canadian dividend investors. Canadian eligible dividend stocks to TFSA first, tax-free eligible dividend credit, preserved in non-registered if TFSA is full. U.S. dividend-paying ETFs to RRSP, withholding tax exemption under Canada, U.S. tax treaty. Non-registered last resort after TFSA and RRSP are maxed. Getting this wrong costs a Canadian dividend investor thousands of dollars per year in unnecessary tax, often without realizing it. The misconception: a company that has paid and grown its dividend for 25 consecutive years will keep doing so. The track record is the guarantee. Where it comes from. The Canadian Dividend Aristocrat criteria, typically 5+ years of consecutive dividend growth, and the U.S. Dividend Aristocrat list, 25+ years, are used precisely because long streaks demonstrate financial resilience. It is a reasonable starting filter. Why it is incomplete. A dividend streak is evidence of past financial strength, not a guarantee of future payments. Every dividend cut in history came from a company that had previously been paying its dividend reliably. The market always believes the current payer will continue until the moment it does not. The specific factors that end long dividend streaks. Structural industry disruption. A company's business model becomes uncompetitive due to technological change, new entrants, or regulatory shifts, and cash flow that once supported the dividend disappears. Excessive debt. A company that has been growing its dividend while also taking on significant debt may face a point where the debt servicing costs crowd out the dividend, particularly in rising interest rate environments. One-time capital needs. A large acquisition, lawsuit settlement, or regulatory penalty can require a temporary or permanent dividend reduction. BCE, as the specific Canadian example, BCE had been paying dividends since the 1800s and was widely considered among Canada's safest dividend payers. The 2024 dividend suspension shocked many investors who believed the long streak was itself a guarantee. The corrected understanding: use the dividend streak as a positive signal. It demonstrates financial consistency over time. Then verify it with current fundamentals: current payout ratio, current debt levels, current earnings trend, and whether the business model faces structural challenges. The history is evidence. It is not insurance. Let's come back to where we started. When a dividend arrives, you are not richer. The share price fell by the same amount. This is the most counterintuitive truth in dividend investing, and understanding it correctly does not make dividends less valuable. It makes their actual value clearer. Dividends are valuable because they force capital discipline, because they provide return during flat price periods, because reinvested, they compound powerfully over decades, because in Canada, inside a TFSA, they are entirely tax-free, and because growing dividends from quality businesses are one of the most reliable mechanisms for building long-run wealth available to Canadian investors. They are not valuable because receiving cash makes you richer on the day it arrives. They are not a guarantee of safety. High yield is not a quality signal. History is evidence, not insurance, and the account you hold them in matters enormously. 7 misconceptions. 7 corrections. Every one of them, understood clearly, makes you a better dividend investor. Not by changing what you own, but by understanding why you own it, how it actually works, and where it fits correctly in your financial life.